going into this year, the debate was hard or soft landing. Is there even going to be a landing?
Well, you didn't have to necessarily have a hard landing to have no Fed rate cuts. I was of the opinion that you wouldn't have a recession in 2023. I don't think you're going to have a recession in 24. That doesn't mean that it's going to be ripe for an environment where you need to cut rates. Right. So I think we have a labor shortage in the United States. That means that wages are going to stay persistently high. You mentioned that oil has reared its head again. And I think that a lot of the measures that the Fed is looking at are outdated, right? They're 30-year-old measures that really, the U.S. economy is much more complex today. So the complexion of how consumers are spending and where the consumer strength lies is with a cohort that's less than 50%. They're driving more than 2/3 of what drives the overall 2/3 of the economy, which is consumer spend. So the folks that are earning less than $70,000, and that's where I draw the Maginot line, are barely getting by. They're spending everything they earn, or they're spending more than what they earn. And the government assistance, the year rollover in terms of when government assistance, extra COVID stimulus rolled off from a lot of the programs was March last year. So what you're seeing is steady state spending on over 50% of the U.S. economy, and the 46% of the households in the United States don't feel any pressure. They're not crimped by inflation so much. They're actually benefiting from inflation because they're making more in their equity portfolios. So it's a different economy than just to say blanket, let's look at this rule for the Fed. And I think you have to go bottoms up to really look at what's going on with the economy.
How closely do you think the Fed watches the change in demographics is one thing. And do you think that what you just highlighted so far, this kind of two-speed economy in the economy, does that mean that the Fed is ready and should be cutting rates this year?
The answer is I don't know. So when the data is reported, it's reported on a very minute level. So it's versus last month, and it's a growth number. I look at it on a much longer time sequence, so I can get a story out of it, and I can understand where we are relative to where we have been. And also, the Fed, if the data is, they're taking it on. I'm going and looking at and analyzing the data and looking at how much consumers are spending on their after-tax earnings and where the wiggle room is and where there isn't. And then also, I have the benefit of looking at all the companies that are giving me micro data. So, for example, the dollar stores last year said that the consumers were really stretched. Their customers were really stretched because the stimulus money was rolling off. That happened beginning March last year. And then I also look at American Express, whose customers are spending like gangbusters. And then I look at detailed consumer spend in terms of all categories that are. It's not the survey data, but it's actually the real-time transaction data, all publicly available data if you want to look at it. Leisure spend has never slowed down, right? So there are categories that have slowed with like retail, and people always look at furniture and outdoor, all the Home Depot type. Well, if people aren't moving, they're not buying new sets of outdoor furniture and hard appliances. So that'll pick up again, but you have to look more closely and understand the stories behind the numbers to really understand what's going on.
How does the Fed factor that in? I mean, they want to avoid the error that they made as well in thinking inflation was transitory.
Yeah.
So is the easy trade for the Fed to just keep rates where they are and just see where, until it's blatantly obvious in their face what to do?
I think so. I don't think we're going to. I don't think the Fed. Which Larry Summers has this great expression that he thinks the Fed has itchy fingers, and I don't think the Fed needs to have itchy fingers because the economy is doing well, and it's not as if they don't cut rates, the economy is going to fall off the cliff, because that's just not going to happen. The consumer's too strong, and also we're in an election year, and both, Biden has shown that he has, really no problem spending money. Trump has, his record, he didn't have any problem spending money. So you've got consumer spending and the government spending, and that's going to clearly lead to continued economic growth.
What are we expecting in this jobs report? Then what are you looking for?
I think you're going to see more of the same, which is strength. So you've seen 500 or give or take 500,000 layoffs in the tech sector. It's really been concentrated in the tech sector. And what you see there is what I think is something strange happened, not something, a real shift happened post-COVID. So pre-COVID, most of the people who were working multiple jobs were lower paid employees. So 30%, for example, 70% of the workers working multiple jobs were non-college educated. Yeah. Post-COVID, it's just 50, and I think that's understated. I think more than 50% of college grads are working multiple jobs. And I'll give you an example. Amazon sells for $20 a mouse jiggler, so it will look like you're working on your on a laptop while you're away, perhaps working another job. Now, who knows about this? Tech jobs, yeah. Right? Luddites like me don't have a mouse jiggler, yeah. Right?
No. That's fairly useful, actually.
Yeah.
And I hope my boss isn't listening.
I didn't think that existed. We're asking you for what you're seeing, right? The canary in the coal mines here right now. Obviously, we talk about commercial real estate as maybe where we might see the Fed's tightening really take toll. But you're focusing a lot on the housing market.
A much bigger market, right? So you look at
what trends are you seeing
market,
in particular?
It's 13, 14, in terms of the mortgage market, but in terms of the overall size, you're looking at a quantum. Yeah. A differential in terms of, and it's the largest asset in the consumer balance sheet.
So, and what are you seeing in particular here?
What I see is, being here in Hong Kong and talking about Asia and most developed economies, you have a demographic problem. You have more seniors, fewer working population. And in the U.S., by 2035, you'll have more people over 65 than under 18. And the issue in the U.S., most people who are over 40 own 90% of the housing stock. 74% is owned by people over 50, and 56% is owned by people over 65. Wow. So there are a couple of issues. Number one, they need to downsize because empty nesters, AARP estimates that over 51% of people over 50 downsize. That's not my numbers, that's AARP numbers. The one thing that is also what is very clear, which is this is White House numbers, that 70% of seniors will need long-term care. 1 in 10 can afford it. So from an affordability standpoint, seniors own, or 79% of seniors own homes. That's going to be the safety net that they need to access to be able to pay for care. And I think they're going to have to be creative solutions, one of which is selling your home, another which is perhaps a reverse mortgage. There's a new product called an equity share, whereby someone will come in and be an equity partner in your home. That's probably the least affordable option. And then the other issue is multi-generational housing, which is really not in vogue in the States, which will need to become in vogue. Or there was a famous show in the States during the 80s and 80s, the Golden Girls. I think you're going to have more Golden Girls type housing.
So why haven't we seen that correction? In the housing market?
Because there's been so little supply. Okay. So, for example, existing home sales were less than 5 million last year. And at the peak, they've been 7 million. That was 2005. So they've been bumping along a low level. And as you know and your viewers know, if there's not liquidity, you can't get a really true clearing price. Yeah. And so I would argue there's no real true clearing price. That's clearly the case in New York City, but it's also the case in other markets as well. I think arguably it's going to be the case in Florida, other markets as well. And importantly, there's plenty of housing nationally. So if you look at household units to households, it has historically been anywhere between 1.09 and 1.12. And today it's at 1.11. So there's plenty of housing stock. It's just not where people want to live. Right. So there's been what I spent so much work on at the early part of 2010 is where I thought growth would come from in the United States. And I thought it would, unlike past economic cycles that were regional based, it would be state specific. And that's exactly what's happened. So you see states like Texas and Florida and Georgia and Utah and South Carolina, North Carolina have just incredible growth and in-migration, and states like Connecticut, New York, New Jersey, Ohio, Illinois have very low population growth and in many cases out-migration. California also has out-migration. Right. So what does that do to the tax base? It hurts the tax base. They have to cut social services, and it is a vicious cycle.
So let's take that and let's extrapolate that 20 years. How does that look in 20 years? And why should I care as an investor, for example?
As an investor, why you should care is because if you are looking to buy a house, it will behoove you to wait longer. Okay. If you're looking to sell a house, it'll behoove you to sell sooner, right? And I think there's it's not going to be there's going to be a massive drop. I say 20% retracement. That's pre-COVID. Housing valuations. It could be more in areas where there's less opportunity, and it could be less in areas where there's more opportunity. The housing stock is disproportionately where economic opportunity used to be, but isn't necessarily today.
That's a good point.
And a lot to do is with Gen Z, right? And the change that you're seeing, the behavioral and consumption patterns there, particularly when it comes to young American men.
Yes. Yeah. So it's not so much Gen Z. So I look at, and I'm unpopular by calling this the avocado toast generation, because it's not just fair to say Gen Z. It's the bottom half of the millennials. So it's 38 and below. So the 38 and below millennials came into their teens with the birth of Xbox, Wii, and Nintendo. And so they were brought up gaming and thinking they were a part of something social by gaming with their buddies, but actually being a part of nothing by being in the basement gaming. Yes. And so that exploded, and it really, I think, caused a chasm in terms of socialization. So today you have the highest rate of single young men, and that's defined between 25 and 34. These aren't men living, just getting out of college and staying with their parents. These are grown men. 1 of 5, 20% of which live at home with their parents. So they're not getting out. They're not. It shows the average home first-time buyer is much higher. I think that will have a longer-term impact in terms of you already have the lowest home household formation rate in 160 years. I don't think that's going to improve anytime. And the U.S. is not alone. I think you see this is occurring in China. This is occurring in other countries. But in the U.S., for me, where I focus on the U.S., you've got a demographic shift of older people needing the money to come out of homes, and younger people. So the supply is going to get heavier. The demand, I don't see, short of sort of front-end load strength, I don't see a long-term demand scenario that begets even stable home price valuations.
Well, what are the implications then to monetary policy? So if there's I don't know if you would call it a structural deleveraging of the consumer. If people are not leveraging up to buy houses anymore, does that have an implication on the Fed that tries to control, for example, mortgage rates and home demand as a way to control the economy?
It's beyond them. I think it's gotten beyond monetary policy. And, we'll see what happens. They can control short-term rates, but long-term rates, I would argue, will stay higher for longer.